Hi, my name's Cameron Kusher, and I'm here today to give you a Tasmanian economic and housing market update and outlook. I'm the Director of Economic Research at PropTrack. So we're going to start with a bit of an economic outlook and have a look at how the things are tracking at the moment. So if we look over the last 30 years, economic growth across Australia has averaged 3%. Over the past 12 months, the economy's only grown by 1%. Outside of the pandemic, that is the weakest economic growth since the end of 1991. On a per capita or per person basis, the economy has fallen by 1.5% over the past year, and it's fallen for 6 consecutive quarters. That's something we've never previously seen. The thing that's supporting the economy at the moment is that strong rate of population growth and government spending, which has been quite strong as well. Inflation's been the country's biggest headache over the last couple of years, and it's still a problem for us. So the rate of annual inflation has slowed, but at 3.8% for headline and 3.9% for underlying inflation, it's still way too high. It's supposed to be within the 2 to 3% target range of the Reserve banks. They're currently not forecasting underlying inflation to come back into the target range until the end of next year or early in 2026. Headline inflation is likely to fall back into the target range, but this is because of a lot of subsidies and rebates that are on offer from governments around the country. And temporarily, they will provide relief to households. But once they are removed, they're likely to be inflationary again. So that's why the Reserve Bank will be focusing much more on underlying inflation. And because we've had that high level of inflation, interest rates have increased. So the cash rate's currently 4.35%, which is the highest it's been in 12 years. The current expectations from the market is that there won't be any cuts this year. And we know a lot of people were anticipating interest rate cuts late this year. And we're looking at the moment at the first interest rate cut in February of next year, with several interest rate cuts through the remainder of the year. And that will obviously bring mortgage holders relief, and it will also increase borrowing capacities for people looking to purchase properties. The labour market's been really the strong point of the economy over the last few years. So the unemployment rate in Tasmania is 4.4%. You can see that it's way below the longer term average. It is a little bit higher than what we're seeing nationally, but it's very low, and it's been a long time since the labour market's been this tight. There's certainly signs that things are easing, though. The number of employed persons has declined by 1.7% over the past year. We are seeing more job vacancies in the market as well. So don't be surprised if the unemployment rate does lift a little bit from where we are at the moment. In terms of the lending environment, we're seeing that subsequent buyer lending in Tasmania, so that's upgraders and downgraders, is up 30%. At a national level, that's only up about 14%. So that's the strength of the market in Tassie at the moment. First home buyer lending's up 1.9%. Nationally, it's up about 11%. And investor lending's only picked up by 5.9% over the past year, whereas nationally, it's up by around 30%. Turning to the supply of new housing, there's a lot of challenges with delivering new housing at the moment, and the federal government has a goal to deliver 1.2 million new homes over the next 5 years. One of the big challenges is just how much materials and the cost of construction has gone up over the last few years. So input costs, which are the materials, they're up 34% over the past since the pandemic. Now, they are only up 1.1% over the past year, so that escalation has slowed. Then you've got output costs, which is constructing. So for houses, those costs are up 41.5% over the past through the pandemic, and they're up another 4.3% over the past year. Other residential, which is higher density, you can see that those costs have risen by 7.7% over the past year, and they're escalating again. Now, they are only up 25% since the beginning of the pandemic, but they're heading in the wrong direction. And the rise in these costs pushes up the cost of new housing and makes it less desirable for buyers. It also pushes up the cost of major renovations to properties and makes people show a preference for buying properties that don't need a renovation. It also obviously makes it much more difficult to deliver the quantity of housing we need. And that's problematic because the population is growing so rapidly. So you can see in Tasmania, there has been a big pullback in dwelling commencements. There's still quite a lot of housing under construction. That's mainly because everything is taking longer to build. but that pipeline behind is really thin at the moment. And then if we look at population growth, it's been very strong at a national level over the past few years. And you can see that net overseas migration into Tasmania, albeit low in the overall scale of Australia, is at pretty much record high levels, but natural increases at record low levels. And we are seeing a lot fewer people leaving Tasmania than are coming to Tasmania at the moment. So let's have a look at what's happening in the housing market. Over the past 3 months, prices in Hobart are up 1%, whereas you look in regional Tasmania, prices are down 0.5%, and they've fallen across each of those three major regions that we've got listed there. Over the past year, though, those results have been flipped. We've seen weaker growth in Tasmania, in Hobart rather, prices are down 0.5%, whereas in regional parts of Tasmania, prices are 1.6% higher, with the southeast the only region where prices are lower. But in the context of the broader national market, growth is very weak. We've seen price growth of as much as 23% over the past 12 months in Perth. And one of the main reasons why we're seeing weaker growth is there's actually been quite a lot more stock on the market in Hobart and across Tasmania than what we've seen elsewhere. So in Hobart, the number of new for sale listings is down from a year ago. It's down 17%, and it's now lower than that average in August between 2018 and 2022. So that supply of new stock coming to the market is moderating, but there is still a lot of stock overall on the market at the moment. So the total number of properties for sale is up 7.1%. And if we look at an average in August between 2018 and 2022, there's 58% more stock on the market in Hobart at the moment. You can see there's also been big increases in Launceston in the northeast and in the southeast, a more moderate increase in the west and northwest. But at the moment, buyers have a lot of choice. And there's not as many active buyers in the market. So we are seeing sales volumes a bit lower. Now, they are a little bit higher than they were a year ago. They're up 4.5%. But if we compare to sort of what was happening in August 2019, 2020, and 2021, sales volumes are lower over that period of time. Again, Launceston in the northeast, a very large increase in sales relative to 12 months ago. We're also seeing quite low levels of inquiry per listing. Now, this is a function of lower inquiries, but also a lot more stock. Inquiry per listing in Hobart is marginally higher than it was 12 months ago, up 6.9%. In regional Tasmania, it is also marginally higher, up 4.6%. But again, things are quite mixed. You can see in the southeast, it's lower. Launceston in the northeast and western in the northwest, it has increased. And properties are taking a lot longer to sell. So a year ago, the typical property in Hobart would take 27 days to sell. It was now 50 days. If we look at the average in August between 2018 and 2022, it was taking just 14 days to sell a property in Hobart. And then you can see similar trends right across the state with days on market more than doubling in all of the areas except for West and Northwest over the last 12 months. So buyers are being a lot more discerning. They've got a lot more choice, and that means properties are sitting on the market for longer, and vendors need to be a lot more realistic about price expectations. So in terms of the established housing market, what's our outlook? Firstly, at a broader sort of macro level, price growth has been really strong over recent decades. And there's been several factors that have driven this, but mainly it's been about borrowing capacities increasing. So interest rates fell from 18% at the start of the 90s to about 2%. That meant people could borrow a lot more. Credit did become a lot easier to access through the 90s and 2000s. Over the last 10, 15 years, credit has been a lot harder to access, and I don't think that's likely to go away. So that's reduced people's borrowing capacities after it was boosted significantly in the previous 15 years. Employment participation rates are pretty much at record highs. That's because more women have joined the workforce. As more women have come into the workforce, household incomes have increased. People have been able to borrow a lot more. So given those three factors are not likely to be as strong going forward, the expectation is, yes, prices will likely still rise over time, but the rate of price growth is going to be more moderate. We're seeing quite weak demand for housing across Tasmania at the moment. Even though we've seen prices falling and there's a lot of stock to choose from, it's just not really leading to an uplift in purchasing behaviour. That lift in the supply of stock available for sale has led to the price falls, and it's giving buyers a lot more choice. And people just don't have that fear of missing out in this market because there's so much coming onto the market. So vendors really need to be very realistic on their price because buyers can be a lot more selective in this space. I think that high cost of new housing is likely to see people preference existing homes, especially while there's a lot of existing homes to choose from in Tasmania at the moment. And it'll be people don't want to do major renovations to their properties or buy properties that need major renovations. We need more housing. Probably this is probably not as pressing in Tasmania as it is elsewhere, but it would be good to deliver some more medium and high density housing in established areas. But there's a lot of political and financial hurdles around that. And I think that the high cost of renting, although it's not escalating as much in Tasmania, we'll see people with the capacity to do so to become first home buyers. And we'll talk more about that when we look at the rental market, which we're delving into now. So you can see here that over the recent months, we've seen growth in rents has generally been quite sluggish. And if we look over the last 12 months, rents in Hobart are up 4%. They're up a little bit more than that in the southeast, up a little bit less than that over the past year in Launceston and the western northwest. At $520 a week, though, compared to where we were 5 years ago, rents have increased quite substantially. We have seen rental yields across Tasmania slump over the last couple of years, but rents are rising faster than prices. So rental yields are starting to repair, but they're certainly, if you're looking to invest on a rental return basis, the returns are nowhere near as attractive in Tasmania now as they were a few years back. We are getting a lot more rental stock available. So new rental listings in Hobart were up 17.5% from a year ago, and they're 23.5% higher than that August average. A bit more mixed in other parts of the state. Generally, stock levels are a bit higher, but you can see the southeast has seen a big fall in new listings, and Launceston's seen a bit of a fall as well. We're also seeing fewer properties overall on the market, but we're still seeing a heightened level of stock. So even though the number of rental listings is down 24% from a year ago in Hobart and down in Launceston and down in the southeast, compared to that 5-year average, there is still quite a lot of stock listed for rent at the moment. So renters have a lot of choice. They can be really a lot more discerning in this market than they can be in most other capital cities. Although we are starting to see a little bit more inquiry per listing. So rental inquiry per listing is up 58% in Hobart, up 28% in regional Tasmania, and quite a jump across each of the regions, probably most notably though in Hobart and in Launceston. The vacancy rates are a bit volatile month to month, but they're still pretty low on a historic basis, albeit they have in Hobart fallen. They've fallen in Launceston, but they've increased in the western northwest. And then if we look at how long properties are sitting on the market for when they're rented, so at the moment it's 22 days. A year ago it was 24 days, but that 5-year average was 18 days, which just shows you how tight rental conditions were and how much they have loosened off over the last little while. But again, interesting to note that generally rental days on market is a little bit lower than it was a year ago. So what's our rental market outlook? There's been several factors that have driven the rise in rental prices. A reduction in household size through the pandemic, low levels of new construction, and then rapid population growth, mostly from migrants who are looking for somewhere to rent. We have seen rental growth over the last year, and it's actually picked up in Hobart and most of Tasmania compared to the previous year, but it's still quite slow compared to the rest of the country. And we're seeing that level of supply fall from a very high level. So renters do have a lot of choice in this market. The biggest problem for renters, though, is the capacity to afford the rent, given how much rents have gone up, how much the cost of everything has gone up over the last few years. So people are looking to rent in less ideal locations, into smaller properties, or moving into share housing or bringing someone in to live with them simply because they just can't afford to rent by themselves. How do we address the shortages of rents? We need more housing, basically, and we need more people investing in housing, which we're starting to get. The other thing we need to look at is the demand side of things, and the federal government's looking at capping migration. Whether that's successful and whether they can actually do it remains to be seen. Helping people with increasing rental assistance. Now, they've done that for 2 years in a row, but that's after 20 years of virtually not touching it. And people on lower incomes are most at risk at falling into homelessness. The other thing you can do is encourage people to become first home buyers, but with the cost of living surging, with rents having gone up so much, people just don't have a lot of spare cash lying around. The expectation that rents are likely to increase further, and again, in Tasmania, we are seeing a moderation in that supply, so we might see some rents increasing further, albeit not as dramatic as other parts of the country. We are seeing investors come back into the market, so that gives people more choice. But I think that as interest rates fall next year, people that are renting are going to be looking at how can I get that secure tenancy, and people with the capacity to do so will be much more inclined to purchase if they can, especially as borrowing costs fall. So that's the end of the presentation today. Hopefully it's useful for you, and hopefully you have a good rest of the year, and hopefully the market's kind to you. But thank you for tuning in, and I'll see you next time.